AI investors. We are looking at a few charts today. Just relative quick update as usual. Try to keep it short and sweet. Looking at total returns of SPY versus GLD versus Newmont. A lot of people are saying how gold is a great investment, store of value, etc. Here I'm just starting from '05 to present. And you could see here that the total return on SPY is about 306%. Over the same period, GLD yields about 278%. Still good gains, but not as good as SPY. And Newmont is negative. So it doesn't pay to own Newmont over a long period of time. A minor. Unless somehow something fundamentally changes, Newmont looks like, in a long-term investment standpoint, looks like an underperformer. So basically, this SPY is a great investment over a long period of time. This is more about investing, not trading. And GLD, yes, it has a large gain, but recall that the GLD has special tax situation. So, consult a tax professional, but when you sell a GLD, you get taxed at a higher rate than if you sold SPY, for example. So that's just something to keep in mind. So we do see this red is the SPY and the blue is the GLD. Newmont is the green. One could argue that if the spread is very wide between the SPY and GLD, that makes one better than, if you're contrarian, makes one a better buy than the other. So, for example, in 2012, the SPY was probably a better buy than the GLD, because we see that the GLD came down in the subsequent years on a relative basis, whereas the SPY increased. So when we see that kind of outperformance of GLD, it looks like you want to be buying the SPY. Now we haven't seen that relationship carry forward to here. We're seeing much more tight correlation between gold and the S&P. Ever since it looks like, let's just call it, well, 2016 or so. There's a pretty tight correlation here between the S&P and gold. Whereas there was a pretty big divergence in 2011 and 12 between gold and the S&P. So one could argue maybe there'll be another period of divergence one way or the other. Gold might outperform the S&P once again, and the S&P will be a buy on a relative basis once again. But that remains to be seen. We see that this exponential growth line, when it's below that, usually S&P is a good buy. Here it's just above that, so I'd say it's probably not a wonderful buy, but as it gets beneath that exponential growth line, which is the long-term average of returns, it probably could improve your chances of long-term returns in S&P 500. So basically, I wanted just to show you that gold, while a good investment, SPY on the same basis is a better investment over this time period. And you could play around with the time periods and come up with different things. But over a long time period, 20 plus years, it looks like SPY outperforms gold. So that's kind of why you want some investment in the SPY. And usually the SPY over a very long period of time outperforms because you do have compounding of the dividends, and that does make a difference. Now, I want to look at a couple other charts here, kind of macro charts. S&P 500 PE ratio, we see is quite historically high. The median is 16, mean is 16, median is 15. S&P PE ratio is currently 28.23. So it did come down slightly, but it's nowhere near, let's just call it 16. Nowhere near that. We'd have to have a 30 to 40% correction to get back to the mean, a mean reversion event, which would probably mean a recession would have to happen. And we had mean reversion before the 08, 09 crisis, right? Tech bubble was a mean reversion event. And I'm sure there'll be some other recession make up the reason why coming in the future at some point. But just from a macro point of view, it looks like we need to revert to the mean, which would be around 16 on the PE. Now, what that looks like, who knows? Because the next point is the S&P earnings are going up, right? So if the S&P earnings, the E in PE is going up and the price should be going down. So in other words, the PE should fall if this earnings is robust enough and can really accelerate higher. It would bring down the PE ratio potentially without a financial crisis. That hasn't been the historic norm, like in the other crashes we see to the mean. So I do wonder, that's a big question. Will the E grow fast enough? Will AI or whatever, contribute to the E fast enough so that this PE ratio comes down a bit? So that remains to be seen. And we're seeing also S&P 500 dividend yield is like near all-time lows. And usually when that is at all-time lows, that's not necessarily a great sign. Kind of underscores how unhealthy the market is, because the last time it was this low was right here, basically right in the tech bubble crash. So there's a lot of similarities here between the tech bubble crash and where we are just prior to the tech bubble crash and where we are today. So not to call in for a crash, but I'm just saying there's a similarity there in the S&P 500 dividend yield. We're nowhere near the mean or median for the dividend yield. Again, we'd have to at least have a 40 to 50% correction in the S&P 500 to get this dividend yield back up to where the mean or median should be historically. So I think we're pretty overbought here, from an investment standpoint on the S&P, and there'll be better times coming to buy, in my opinion. All right. So yeah, and I wanted to pull up this Fred chart of the M2, and we saw the M2 dip a little bit when they said that we didn't have a recession, but in 2022, but we saw that in 2023 into 2023, we saw the M2 turn negative, and that hasn't happened pretty much any time in history. But then again, we haven't had a spike like that in the M2 money supply anytime in history. So here we saw that growth rate of an M2 turn negative. And then here we're seeing it pick up again, turn higher. M2 just continues to be kind of an exponential growth. Unless something cataclysmic happens and you see the M2 go down, I would think that would probably correlate pretty strongly with the stock market also having a correction. So, which brings me up to the next point, which is the chart of SPY. So chart of SPY here, we have a couple of patterns I just wanted to note. This is trading view. Let's see, we have this Elliott wave pattern happening inside a megaphone pattern, and then we had a breakout of the megaphone here. This is back in 2019, 2020, right? So we had a breakout of the megaphone pattern. But I think this is what I'm seeing. I am seeing that we're entering an ABC pattern where we have A, B, C. Now, who knows how far this will go? We don't really know, but we're having a Elliott wave here in a megaphone pattern. Then we're having an ABC correction to the upside for the S&P 500 for SPY, that is. And I think the next wave will be a corrective wave. So we had this kind of periodic consolidation, Elliott wave, megaphone, and breakout in the ABC pattern. Now I think that we're going to have some corrective wave over here. One thing that disturbs me about this chart is these gaps here. One pretty large gap right at 441 that looks like it needs to be filled at some point. We had a gap here, for example, at 330 or so, right? And that got filled. We went down, that got filled on the way back up. So I think that will be filled at some point. I can't predict exactly when, but at some point, this might have some kind of maybe a bounce or something like that. And then, there'll be some corrective action that will lead us down to, let's just call it, there's a little gap here, 423 or so in this zone here. And then I think we'll be off to the races again once we get that gap, that growth scare filled. And it's likely to be accompanied by an unemployment increasing and financial distress and other things happening where you start to see home sellers panic and they start to cut their prices on their homes in 2026, 2027. So this is kind of like a 2-year scenario that I'm drawing out. Yeah, and then I expect some consolidation in this area. And then we're going to be right off to the races again because the S&P 500 has no history of going down for any like long periods of time. For if you, as long as you hold the S&P 500 for let's just say 20 years or more, you basically cannot lose in the S&P 500. So I do think we'll have this zone here, maybe between 440 and let's call it 400-ish of consolidation before we head on up. So this is just my kind of thought process on the SPY. There are other ways to draw more short-term like lines here. You could perhaps connect these bottoms here and see maybe in a corrective wave we might be headed and testing this 520 area, and if we break that, then perhaps we get the gap fill that we want or we think we want down here, but that remains to be seen. And yeah, there's a short-term trend that could be drawn maybe between these lows as well, this reaction low, that reaction low, and we pretty much broke that, right? So perhaps that's where the retest comes in. We see maybe there's an area of consolidation, perhaps some kind of retest or something, and then we test this trend line. Don't know what's going to happen. We'll see. If it breaks, then we're likely headed back down here to 440. That's kind of where I see this market going over the next, let's say, 2 years or something. Not immediate. This is more a middle term investment strategy. This isn't an intraday investment strategy by any means that I thought I would share with you guys out there. Anyway, happy Sunday, and I will see you on the next one. Take care, all.